Yesterday, one of my friend asked me for an advice. He was like, my father has this lump sum money and he wants to invest it in some kind of an asset to generate regular income. The first thing that came to my mind was fixed deposits. But obviously, it pays for about 6 to 6.5% per annum. And after tax, it's almost about 4 to 4.5% in return. And the other investment opportunity that came to my mind was investing in dividend paying companies. But again, stock market is bit on a risky side. So I started looking out for better answers. That's when I came across bonds and NCDs, which are relatively more secure and gives out better return when compared with fixed deposits. So in this video, we are going to understand what are NCDs. Well, let's say you're running a company and you need some cash to expand your business or complete some projects, but you don't want to take a loan from a bank or go for an IPO. That's where NCDs come into play. NCDs basically stands for non-convertible debentures. It is a type of debt instrument issued by companies to raise money from public, which is not convertible to equity or shares. Generally, NCDs are not backed by any collateral. Investors can only rely on the credit worthiness of the companies. Isn't this strange? But not to worry. Reputed credit agencies like CRISIL rate these NCDs based on the credit worthiness of the company. So now let's look at why would someone invest in these NCDs. Number 1, high interest rates. NCDs usually have a return of 11 to 12%, which is really high when compared with other investment options. Number 2, verified credit ratings. Any company that seeks to raise capital by issuing NCDs has to go through agencies like CRISIL, ICRA to verify the information provided. Number 4, regulator. All these companies that are issuing NCDs are closely monitored by Reserve Bank of India, which benefits the investors. NCDs do not attract TDS on interest earned. The interest income is added to the total income while filing for income tax returns. So who is it for? Well, at a time where fixed deposits are offering a single digit return with of inflation of about 6 to 7%, the real rate of return is very less or even negative. So people are now looking at investment opportunities with high fixed rate of returns like NCDs. So now that we have learned who should invest in NCDs or why one should invest in NCDs, now let's take a look at few factors that one needs to consider before investing in these NCDs. Number 1, check the credit ratings. High interest ratings offered by these companies should be backed by a good credit rating as well. Study the credit ratings given by different agencies like CRISIL, for example. A higher credit rating will suggest that the company can repay its loan. Number 2, debt ratio. Before you invest in these NCDs, you should check the financial statements of these companies. Debt ratio is a financial ratio which is used to show what portion of the company's asset is financed through its debt. For example, a company with 2 lakh rupees in total assets and 50,000 rupees in liabilities would have a debt ratio of 25%. And finally, we have interest coverage ratio. ICR ratio is used to measure how well a company can repay its interest that is due on its outstanding debt. If you learned something new, please don't forget to like this video and share this with your friends. And for regular updates, please subscribe to our channel.